So we're talking about interest rates. Will they ever come down?
Seriously, you got to bring it way down.
It's Karim Rahimtullah for Trade Day Tuesday. Trade Day Tuesday. Trade Day Tuesday. Hi, this is Karim Rahimtullah for Trade Talk Tuesday. Today I'm going to focus on a topic that nobody's talking about: inflation, recession, interest rates. Now, everybody's talking about it. They all want to know what's going to happen. What's happening with inflation? Are we in a recession? Are interest rates ever going to come down again? Well, I'm going to give you a couple numbers, okay? The first number I'm going to give you is 5.4%. So 5.4% is the average interest rate over the last 30 years. Right now, we're at like 2.5% or something like that, something crazy low. So interest rates are not going down anytime soon.
You just keep that.
They're going to go up a little bit first, and then they're going to come down. And I'll tell you why in a second. A lot of this has got to do with a term called reversion to the mean, okay? Reversion to the mean means that things tend to go back to where they normally trade. For example, inflation. The average inflation rate in US history is like 3.8%. And we were sitting at less than 2% for the last 15 years, okay? And now we're at 9%. 2% was way too low. 9% is way too high.
Well, what are we supposed to do now?
It'll come back down probably around 3.8% or maybe 3.5%, but it might take a year to happen. So the longer it takes for inflation to subside, and it's one of these self-fulfilling prophecies, when prices go high and they get higher, the best cure is higher prices because people spend less, leads us into kind of a recession, which is a slowdown. And be careful about the word recession. The word recession just means a pullback in GDP. It doesn't mean we're going to go down 15 or 20%. It could be like pullback of 1% or negative 1%. So the way they measure a recession is 2 consecutive quarters of declining growth in GDP. So we haven't got there yet. We might get there. It's kind of hard to predict because unemployment rate is still low. People are still finding jobs, but there is an undercurrent out there that's saying things might not be too cool. Although I just got killed by a car dealer the other day. I had ordered a car, went in there, tried to pick it up because it came in. He goes, "Sorry, we're going to sell it to somebody else for a lot more than you're paying, even though you put a deposit on it," which kind of means there's demand out there, right? So as long as demand is out there, interest rates are probably on an upward trajectory. But that trajectory doesn't last forever. And the reason it doesn't last forever is because it gets to a certain point and people stop buying stuff. They stop buying big stuff like homes. For example, a year ago or even 6 months ago, a 30-year mortgage, you could get that for less than 3%. Now it's around 5.7%. So that means you are creating what's called demand destruction. Gas prices at $5 a gallon, $6 if you're in California, $3.99 if you're in Mississippi. But anyway, at $5, gas prices create demand destruction, although you wouldn't know it by all the clogged highways, but people tend to drive a little bit less.
And gas has gone up 7 cents since this morning.
He puts a new thing on the sign every time we pull in there.
We're screwing ourselves here, guys.
So those types of things tend to put pressure on the economy, and once that pressure starts to filter down, interest rates stop going up. Okay? They stop going up because the Fed now has a mandate. They need to keep inflation in check, but they also have to keep unemployment down. So at some point, they're going to stop raising rates or stop raising rates as hard as they are right now. And you'll see inflation, it may be growing, but it's going to be growing less than it is right now. So what you want to focus on, what are these trends? When do these trends become less, not more, weaker, not stronger? Interest rates are going up, but not as fast. Inflation is going up, but not as fast. When those things start to happen, then you start to see moderation set in, and that's when you start to see interest rates start to decline a little bit.
Oh, thank God.
You look at the short-term interest rates are at like 3.3%. Long-term interest rates are like at 3%. So this makes like no sense whatsoever, okay? So why are short-term rates higher than long-term rates? Shouldn't it be the other way around? Yes, it should be the other way around, unless people are anticipating that 10 years from now, economic growth and inflation is going to be lower than it is right now. And that's what they're betting on. So if you've got an outlook that's only like a 6 months to a year, put your money in a treasury and make like 3%. Okay? But if you have an outlook that's 2 years to 5 years, interest rates are probably going to be heading back down in like 2 years, maybe a year and a half, or just moderating. So you don't have a long ways to go. The last thing you want to do is make crazy bets. Like I wouldn't put all my money in a 30-year treasury paying 3%. Crazy bet, okay? You need to get into more diversification. Equities are getting cheaper as interest rates go higher, equities go lower. Once they get to a certain point of equilibrium, you want to be pouring your money into equities. Probably not there yet. We might be there by the end of this year.
All I really want is someone to hold me and tell me that everything is gonna be all right.
Everything is going to be all right.
For Trade Talk Tuesday, I'm Karim Rahimtullah. We'll see you here next time. If you're looking for an opportunity, really cheap one, under $2, okay, probably closer to $1 right now, of a stock that's going to do well, I think, in any environment because it's been so beaten down, truly a value stock, and it's looking like the trajectory for this is very good going forward. Click on the link below for all the details.